Welcome to the Ag Commodity Corner Plus podcast. My name is Mo Agostino, Chief Commodity Strategist with Farms.com Risk Management. It is December 19th, 2025, week number 39. This is our last podcast for 2025. Let's get right into it. Let's have a quick look at the summary. Weekly closes. You got soybeans down again, 27 cents. Soy oil kind of weighed on the bean market this week. It also weighed on canola down as well to new lows. I should have put new lows there. Chicago wheat went to new lows as well. And then as did Minneapolis wheat. Crude oil, new lows. Gold and silver, new highs. So let's get into it. Let's start off with the soybean weekly futures chart. You can see from the chart here that we sat down around that 950 to 1080 for almost a year and a half. That 1080 to 11 is your old ceiling, now your new support. Now we did finally break below 11. We actually filled the gap all the way down to 1060. And so we're just waiting for the funds to finish off their year-end liquidation, end of quarter, end of month. And I think once that happens, we'll get to a bottom here short term. You can see here seasonally, and this even happened last year. By the time you get to December 19th, there's a little bit of a seasonal trend to the upside that takes you all the way up to sort of that mid to end of February. And then you've got these funds who went, it was the third longest position in history. The last high was 2012, and then there was one in 2020. And they went long 229,000. As of the latest CFTC report, the funds are still long 180,000 contracts. So within a very quick, short period of time, as we get updated on these backdated CFTC reports, I think they decided to sell because of that year-end selling, end of quarter, end of month. I mean, if you had a profit, if you were long and you wanted to take some profits, this was a good time to do it. So the Chinese soybean purchase tracker, this includes unknown sales, 47.3%, 5.686 million metric tons out of the 12 million. Some, though, in the trade think that there was a Bloomberg article saying that we're closer to 7 to 9 million metric tons. So it sure looks like China is going to most likely meet the 12 million metric tons by year end. So why are the funds selling? Well, I think the missing link in all of this is the fact that we don't have a Chinese-U.S. trade deal signed. I think that's what's weighing on the market. They're tired of waiting. The Trump administration told us they were going to provide details, and thus far we have seen nothing. These are U.S. soybean commitments thus far as of November 27th. Just over that 1.016 million metric tons. You can see it compares to 2018 and 19 when we had similar forecasts. USDA has a forecast of 1.635 billion. So, we fell behind. China's buying. It's not zero. I think at some point the funds are overdoing this to the downside, and I think it has more to do with the lack of a South American weather scare than anything else. Don't forget our program. Check it out. This week we're talking about will the USDA provide a late January 2026 farmer gift and the impact on grain prices and what to expect if that was to happen. So check that out. We look forward to working with you. Don't forget, we have our app. We also have this free podcast. You have access to me while on the program. You can call, text, or email me anytime. So hope you enjoy it. U.S. soybean exports and domestic crush. We're now crushing more than we are doing in terms of exporting soybeans. The crush was record strong this week again, but understand that even if crush is 100 million bushels more than last year. It won't offset that weak export soybean demand. So it's good news. It's probably the bright spot on the balance sheet, but we're going to need other countries in China to come in a big way with respect to those soybean exports. This is the WTI January 2026 crude oil weekly futures chart, and you can see we traded to new lows there. The glut of supplies globally is weighing. It's getting worse. We bounced a little bit because it doesn't look like we're going to get that peace deal with Ukraine, Russia. We've also had some geopolitics this week where Trump was blocking the oil tankers coming in and out of Venezuela. Half of what Venezuela produces, 749 million barrels per day, half of that goes to China. So Russia did not like what Trump was doing. China has not chimed in, but I still think the glut of supply is going to overwhelm this market into Q1. So looking for lower prices. And Trump also announced that he was going to lift some tariffs off of Belarus, potash exports to the U.S. Belarus ships about 5.7% of the United States potash supplies. So it's a win. It's a small impact, but we need more of this so we can lessen the global tightness in that global balance sheet and fertilizer. We need to see more of this, and if we do, we could see fertilizer prices roll over into the spring of 26. Chicago wheat futures went to new lows right here at the end of this week, and unfortunately, global supplies, the glut, and continues to weigh on wheat futures. You're going to need a rally or a gift in January from the USDA to maybe see prices start to move higher. Global U.S. demand's up 23%, but it needs to be off the charts, through the roof, in order for futures to improve. Ethanol also record strong. We're over 1.13 billion. On track to produce 17.3 billion gallons in 2026. If we can continue to hit this pace because of better production, lots of corn, better exports, even consumption's better than most thought. It's still lower than 2019. It's in that 8.8 to 8.9 million barrels per day, but if we can get if we get lower rates next year, the economy's doing fine, stock market's higher, you got the wealth effect. I got to think that we could get back to that 9.4 million barrels per day in usage. So many are thinking that is the USDA too high at ethanol at 5.6 billion bushels. That's up about 140 million from last year. They may be short term, but the marketing year is young, so we could still hit that target. So I don't think the USDA is going to adjust ethanol lower because of a lower yield. Corn exports to China, there's rumors they bought 4 to 8 cargoes off the PNW. There was no flash sales today to confirm that, but you can see that last year they bought a little bit. I think it was 33,000 metric tons, but this year they've bought 0. Talk about adding fuel to the fire. The corn export program's up 30% compared to last year. USDA target's up 12% after raising it 4 months in a row. So this could help finally break, or one of the reasons why we could break 450 on the corn daily chart. Cattle and feed report, bullish. December on feed in line, but placements and marketing is lower than expectations. The cattle and feeder cattle futures were having a tough time closing above that gap, going all the way back to October 25th at 233 on the live cattle chart and 334 on feeders. But this gives the funds the green light to push prices higher. So look for another higher close on Monday. And then finally, the CFTC update as of December 9th. You can see the funds are still long. That should read 180,000, not 1,8, but 180,000 contracts. So, and that's December 9th, and today's December 19th. I don't know. The trade got this all wrong, and that's what happens when you got a government shutdown. They thought the funds were still short beans. Obviously, they were not. And all of a sudden, everybody thinks that they've liquidated this entire position. Maybe they have, but to me, it doesn't show that at this point. But we'll have to wait and see. Just a warning. The government reopened and funded the reopening, but only till the end of January. So as we get into 26, could the U.S. government shut down again at the end of January? What if Trump wants to shut it down for 2 months? Then we don't get the March planning intentions report. So we're going to be in the dark again, and that's just sad. Anyways, thanks for watching. Really appreciate it. Don't forget to subscribe to the channel. We'll be back on January 9th of 2026. Until then, Merry Christmas and Happy New Year to you and your family.